Welcome to the Bekaert Tax Beat, a conversation about tax that matters.
Welcome to Bekaert's Tax Beat podcast. Today we are talking about one of the best tax savings provisions in the tax code, and a good reason many fast-growing companies may want to be taxed as a C corporation. Shareholders holding qualified small business stock at the time of a sale can take advantage of Section 1202 of the Internal Revenue Code to exclude gain from the sale of their stock from federal income tax. Joining us today in our conversation are Barry Weins, director and member of the firm's national tax team, and Molly Gill, manager who works with our transaction tax advisory team. Molly, Barry, thank you so much for joining us.
Hi, I'm Barry Weins, and I'm sitting in Tampa, Florida today.
Thanks for having us. Molly Gill, located in Arlington, Virginia.
And of course, I am joined by the lovely Sarah McGregor, as always.
Great. Good to be here.
So, Barry, maybe you could start by telling us what does a general conversation with a client look like about 1202?
So a lot of times we will talk to our clients. They're interested in 1202. They've heard about it in some places. Qualified small business, QSBS, all of those are terms that we use interchangeably. The reason we call it 1202 is that's the code section it's based on. So when I talk about it today, that's really where we're dealing with that. So 1202 has sort of two sets of rules. The first set is about the corporation. In order to qualify for the exclusion, I have to have a qualified small business, which is at the company level. And then you have to deal with the shareholder requirements, because if you have a qualified small business, the shareholder has to receive their stock and maintain a certain ownership, so it meets the terms of qualified small business. So that's really how we talk through these rules with the clients.
And clients, of course, come in knowing everything correct about 1202, and you never have to undo some myths or other misinformation they may have.
The clients we talk to and non-clients are all over the board. So a lot of them have done Google or AI searches. Some are correct, some are not correct, some are some of them will admit that they're just, they're basically trying to just gain an understanding. But we always meet the clients wherever they are. So that's the first thing we do, is understand how much experience they have, where they are, and then we work through that to meet them and discuss that with them at their level.
Great. Well, let's talk about the first set of rules, which deals with the company requirements to have qualified small business stock. What does that mean?
Sure. So again, there are a couple rules that deal with the company has to meet certain requirements to be considered a QSB, because it has to be a QSB at the time the shares are issued. So the first thing we will generally talk about is what's the trade or business that it's engaged in. And Molly will talk about that in a little bit. The second thing we'll talk about is, are you a C Corp? Are you taxed as a C Corp? Legal entity type doesn't really matter. It's more in the line of, are you taxed as a C Corp? And then we start getting into some of the more specific tests, such as at the time the company issues shares, do their assets, are they below the applicable threshold, which is either 50 million or 75 million, depending on whether we're under the old rules or the new rules under the OBBA. So that's the first test, because you've got to be under that threshold. The next test we talk about is the 80% test. If you're in a qualifying trade or business, 80% of your assets have to be used in that qualifying trade or business. So when we start talking through that, most of the clients will say, well, all of my assets are used in the qualifying trade or business. And I will acknowledge that that's what they believe, but the test is very specific, and we have to go through these rules. The biggest thing with the 80% test is working capital. So out of your 8 assets, maximum after the first 2 years, only half of them can be working capital to count toward your 80% test. And then we have to walk through the rest of the assets they have, if you're using real property or some of the other things. But what we focus on with the 80% test is it's a value test. It's not what's on your balance sheet. So in a lot of the industries and clients we talk about, there is significant intangible value that is not booked. So what we talk about is how you go about creating sort of a fair value balance sheet so that you can actually do the 80% test effectively. One of the other things that we will talk about there is that there are the gross asset test is a single point in time, basically when the stock is issued, before and after. The 80% test is over a period of time for substantially all the period that the shareholder owns the shares. The test needs to be made. So we talk about all of those different tests. And then we go through a couple other areas that can cause problems with the company, such as real estate, investments in corporate securities, redemptions, and things along those lines, which we'll tackle a little bit later. And then generally what we'll do is we'll hit the shareholder requirements. So those are pretty straightforward. So the shareholder has to receive the stock directly from the company in exchange for cash, property, or services, and then they have to meet the certain holding period. So under the old rules, it was 5 years. Now we've got a tiered structure under 3, 4, and 5. And then we'll talk sometimes, if we need to, about transfers. But a lot of times what we're focused on is the corporations, because they're the ones who are in control of whether they're a qualified small business. It would then be up to the shareholders to make the determination of where they have QSB stock. We're always available to help them with that if they need to, but most of the time we're working with the corporate taxpayers.
Right. And Molly, one of the things that Barry said you were going to cover is about the qualifying trader business. The code section limits which kinds of businesses can take advantage of this gain exclusion.
Yes, exactly. So the code does not explain what are qualified trader businesses. It says everything except these trades or businesses are qualified. So it's kind of, you have to look at it from the other side, see, do we fall into one of these buckets? If we don't, then likely we can get to a position where we can move forward. If you are familiar with Section 199A, they pulled that language for what are SSTBs directly from 1202, made a few minor adjustments. But thinking on what 199A says is you have a lot of service-based industries and like healthcare, engineering, those types of things. Those are not qualified. If it relies on the services that an individual is providing, likely those will not qualify. And then there are some other limitations. Restaurants don't qualify. A lot of things related to real estate, those industries don't qualify. So we look at it and try and see how the trades or businesses do not fall within the excluded outlined items.
So if you're not excluded, you're likely in as a trader business.
Yep, exactly.
Okay. That's great. And so what about when you're doing your analysis, what aspect of the Section 1202 rules confuses clients the most?
So generally, as I said, the 80% test. So again, you have to build back a fair value balance sheet. So what we generally will talk to them about is in corporations, if they're issuing shares or options, they generally have done a 409 Cap A analysis, which gives you sort of an enterprise value of the stock. So that's what we kind of use. We'll start with that, or if you've had offers or you have a transaction on the table, we'll try to look at that, multiples of EBITDA. There's a number of ways to do a value of that. So then what we do is we say, okay, if I know my enterprise value, okay, then think of my balance sheet. Assets equal liabilities plus equity. So I will take my enterprise value, add any liabilities to that, and that will get to my gross asset test, of my gross asset amount. And after that, we only care about what is a qualifying asset or non-qualifying. So you generally will look at, what are the things on your balance sheet, cash, AR, inventory, fixed assets, anything along those lines. And then there's going to be a chunk missing, and that's all intangible value. So whether it's a patent, a know-how, software, R&D, all of that stuff, we don't really care what it's called. It's all going to be counted. And then you just start doing the math from there. So you start saying, okay, I've got all of my assets. Here are my business assets. Then you have to deal with the working capital test, which is a subset of that. How much of my working capital gets to be counted as good assets toward that? And then once you get done, it's a percentage. Good assets over total assets. If it's more than 80%, then we're home free. So usually the challenge with that is determining, one, your working capital first has to be a reasonable amount. And second, then it has to be less than 50%, or some of it may be excluded. So that's really where most of the work comes in, is working back through the 80% test to make all these determinations.
And the 80% test, you said, is over time. How frequently do you have to run this test?
Well, that's a good question. There's nothing in the code that tells you that. So when we're doing these analysis, the first thing we'll generally start with is the tax returns, because they have a good balance sheet as of a date. Everything's been posted. And what we'll do is we'll run the test at the end of each annual period. If you're meeting the requirements at the end of each of the periods, and we're well above the 80%, if you're 90% above, the likelihood of fluctuations in between that time is probably very, very low. But we will ask about transactions that happen during the year to find that out. If you're closer to that 80%, then maybe we want to start testing at maybe mid-year, maybe quarterly. So we'll look at all of that to make that determination. So again, if we feel comfortable that the annual test will confirm that, that's what we'll use. But if we need to, we may start looking at, monthly or things along those lines. In some cases, for the 50 million gross asset test, that has to be looked at every time you do a capital raise. So we'll do that immediately before and after. We'll try to pull a balance sheet from that. That doesn't have to be put on a fair value basis. That's more of a tax basis with a little twist if assets were contributed, but that's a little bit easier to do whenever you need.
Oh, one other thing on the 80% test and the frequency, like Barry alluded to, sometimes people will be invested in real estate or things or corporate securities, things that may cause some issues in the 80% test. So if they're invested in corporate securities and they might fail one of those tests, we'll look at the 80% test for 3, 6, 9 months in greater detail at the smaller intervals.
And the reason for that is when you fail because of these other tests, you're deemed to not have met the 80% test. So even if I have assets over that, if I've got too much of these disqualifying assets, I'm deemed not to have that happen. And remember, substantially all. So if I have at the end of 1 year, I'm good the prior year and good the year after, then the question is, how much time did I not meet it? Well, did I not meet it the whole 2 years, or is it like 3 months on either side? So if we have those issues, we start digging down into more data.
So that's certainly a lot to consider. What hot topics are people asking you about the most right now?
Well, coming out of OBBBA, a lot of people are looking at 1202. The holding period requirements have gone down. So under the old rules, you had to hold for 5 years to get any benefit. Starting in 2010, the exclusion was 100%. However, you had to hold for that whole 5 years. So if you held for 4 years and 11 months, you were out of luck. Now there's that tiered structure, so you can hold for only 3 years and get some exclusion benefit. So because of that, a lot of people are looking to convert, and we're having a lot of conversations about converting from partnerships.
And what are some key considerations you have to keep in mind when making those determinations?
Sure. So when you convert from an entity to a C Corp, one with partnerships, it's a lot easier because the process to convert is a lot simpler to qualify for 1202. But one of the tests we've talked about, the $75 million test, if you contribute property, that has to be factored at fair value on the date of it was contributed, not tax basis. So when you convert, you have to look at the fair value of the partnership at the time of conversion. It's not just what's on its balance sheet. So what we talked about for the 80% test for a fair value balance sheet, we have to do that to make sure we qualify for the 50 and 75 million. So the challenge there is, are you too late or are you good? If you're over the 75 million, I can't convert and qualify. So that's one issue there. The other thing that people have to be aware of is that when you convert in that situation, there's obviously gain inherent in the assets. That gain is not eligible for 1202. So if I convert on a day when let's say I'm under the 75 million test, where my gross assets are under 75, but my fair value is, let's say, $50 million. Okay. The $50 million, that gain that I would have recognized if I had sold on that date is never going to be eligible for 1202 because of the way the computations work. But what it does do is, we've talked about the exclusion a little bit. The exclusion is, again, depending on when you get your stock, the greater of $10 million or $10 or $15 million or 10 times basis. If I contribute property, I now have an enhanced basis for 1202 purposes that would then allow me to claim a bigger 10x. As an example, if I contribute property on the day that has a value of $10 million, okay, that first $10 million, whatever gains attributable, will never be eligible for 1202. But now for my 10x, $10 million is my basis. So my $10 or $15 million exclusion isn't really what I'm worried about, because I've got $100 million available after that. So the valuation becomes important. Obviously, it's per shareholder, so each shareholder needs to determine that. That's one of the challenges. If you're an S Corp, converting to be 1202 eligible is a whole different matter. There's a different structure that has to be done. You can't just flip your S Corp to a C Corp. You can do that, and future shareholders would be eligible, but all the founders would not be. So you've got to be extremely careful with S Corps how you convert into a C Corp to gain this benefit.
Are there other issues that come up that we haven't talked about?
Yeah, so one other thing that I think doesn't get enough highlight is redemptions. So like Barry previously mentioned, you can kind of tell if you're under the gross asset test and the company's meeting the qualifications, they're hitting the 80% test, all of that. If you're holding 1202 stock. But what might not be as apparent is if you issue stock in January and then in September the company redeems stock. Well, certain redemptions, if they hit a threshold, if they're considered significant, they can create a blackout period where a year or 2 years before, depending on if it's a related party, and a year or 2 years after that redemption, there's no eligibility to issue 1202 stock. So it doesn't really become an issue as much for future because, yes, if you make a significant redemption, you're aware that you can't issue any 1202 stock for the next year or 2 years. But what sometimes happens is if that individual got shares in January thinking they had qualified small business stock, and then the company does a significant redemption in September, now they've lost that ability to hold 1202 stock. Redemptions are often an issue. And then the other thing that I alluded to a little bit is parking excess cash in corporate securities. You can't, part of the 1202 rules are that if you're invested in another corporation and it's not deemed to be a subsidiary, then you cannot hold more than 10% of your value in that corporate security. So Sometimes companies, if they do a big fundraise, they'll have a lot of cash. They'll park it into, they're not entirely sure, just investments. And if it is corporate securities, that can cause an issue. And that will create a period at which the company may fail the 80% test.
Great. So on the redemptions, if I have this right, if you had 5 investors who own the C Corporation stock and they all came in January, and then one of them wants to be redeemed in September, it can taint all the shares of stock for all 5 shareholders, not just the one.
Right, exactly. And kind of the policy reason behind it is if you think about it, you have to receive your shares directly from the company in order to hold qualified small business stock. But if you sell the stock, then you can exclude your gain. So say I have shares of qualified small business stock and I want to get out of the company. And Sarah, you want to come into the company. Well, if I sell my shares to you, I'll be able to exclude my gain, but you will not ever hold qualified small business stock. So the thought is, oh, well, I'll just sell it to the company. I'll exclude my gain, and then the company can go about and issue you some shares. So that's why they have this redemption rule. It's to kind of avoid that scenario.
Because of course we would never come up with ideas to circumvent the rules out there.
Or multiply the benefits, I think, is what you're looking for.
Multiply the benefits. So
yeah.
I was just going to say, what types of industries are better or best suited for 1202?
So obviously you're going to need industries that when you sell the stock, there's significant gain, appreciation, things along those lines. Generally, if you've got tech companies where you're developing software, doing R&D, even to develop like medical products, there's a lot of money going into that to develop these that then hopefully will be very profitable. There you also, if you think about what's happening, is I take in $10 million of cash, I spend it, it basically gets converted to IP on the balance sheet, and then I go out and raise more money and continually do that. Those companies are excellent for 1202. The ones where it becomes more challenging is if I have an established manufacturing company or distributor or some other solid type of business, it's generating a nice profit, but the value isn't always going to be there in intangibles. Not only that, you generally will have a lot of working capital. If I'm a manufacturer or distributor, I've got cash, I've got inventory, and I've got AR. Those are going to be your predominant assets sitting on your balance sheet. That's when it becomes more difficult to meet the working capital test, because some of my working capital may not qualify, and then that's going to start driving down my percentages. It's not always evident. It all depends on the business, but generally those startups are where this is really taking off. Silicon Valley, all of those people, they're all over this.
So Barry, Molly, thank you so much for all of the insights. It's been a great conversation. Any final comments from you two?
No, I think the only thing I would say is when in doubt, ask. The worst thing you could do is be told no, which is fine. At least you know that and can move forward. The thing, because there are these little traps, as Molly pointed out, the worst thing would be to come back and find out at the date of a transaction, oh, you might have qualified, except you did X, Y, and Z in these back years that has taken that benefit away. If you know you're a qualified small business, then you can plan around or keep up on where these are and have the conversations before something goes wrong and obtaining the benefit. It's a significant benefit. It's a $10 to $15 million exclusion, maybe more. Now the 3 and 4 year tiers are a little bit misleading. If I have a 3-year requirement, then I get to exclude half of my gain. So if I'm at a $10 million or $15 million limit, 7.5 is subject to tax and the other 7 isn't. The 7.5 subject to tax is really subject to tax at 28%. So you're really getting an overall 14% effective rate. When you get to the 4 year, you're getting a 7.5. And once you get to the the 5-year, that's where you really hit the home run because you got a 0 effective rate on the gain.
Yeah, but just to reiterate, if you ever have any questions, please ask. Barry and I have conversations on 1202. It feels like daily at this point. So we're always happy to have a conversation with any client or prospect who's interested in just understanding a little bit more about Section 1202 and how it may apply to them.
Now, that's great. Thank you both again. We'll go ahead and wrap up this discussion of qualified small business stock and the opportunity to exclude capital gains from taxation. A quick disclaimer, of course, we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully one at Cherry Bekaert, with your specific tax issues or to discuss information from today's podcast. Please do check out our website at cbh.com for the latest guidance and materials on this and other tax and business topics. So again, this concludes today's podcast. Please like, share, and subscribe. Thank you, Molly. Thank you, Barry. Thank you, Sarah. And thank all of you, our listeners, for spending time with us. We truly appreciate it. We will call it a day and go forth in peace.